Fair warning, once you see what we're about to show you, you will never be able to unsee it. There's a lot of talk and a lot of rhetoric right now that the markets are gonna tank, house prices are gonna drop, rates are gonna come down, just a lot of uncertainty and a lot of fear-based commentary. The good news is it's not happening. The bad news is it's not all sunshine and rainbows either. In fact, not even close. Because right now, something is happening in the world that most Americans have absolutely no idea is connected to their ability to buy a home. And the decisions you make this week about that connection are going to determine whether you build real wealth or whether you are still renting and broke in 5 years.
Yeah, so here's the question nobody is asking their loan officer right now. What if the old playbook doesn't work anymore? What if waiting for rates to drop is actually the most expensive decision you can make right now? And what if everything you thought you knew about mortgages and home buying is based on a system that is actively breaking as we speak? Most people do not even know this system exists. They have no idea why rates spiked, and they have no idea why they are staying elevated. And they definitely don't have any idea about the geopolitical stuff happening right now in the news and how it's directly connected to whether they can afford a home or whether they're going to be a forever renter.
So stick with us, because at the end of this conversation, you're going to understand what actually is happening, why the old strategy of waiting does not work anymore, and what you need to do starting this week. Not because we're trying to scare you, but because the data is showing us something that most people are completely blind to. And it is time somebody said it out loud. All right, Anthony, let's start with what most people believe right now. The mainstream narrative is simple. Rates are high, but they're coming down, and the Fed will cut. Inflation will cool, and when rates drop back to 5s or even 4s, that's when you buy. That is a plan millions of Americans are sitting on right now, hands in their lap, waiting for the signal. And here is the fundamental problem with that plan. It's built on the assumption that is already broken down. The assumption that forces that brought rates down before are still in play, and they're not. The world changed underneath us, and most people missed it entirely because it happened so quietly. Nobody made an announcement. There was no headline screaming the end of an era. It just happened. And now we are living in the consequences of that shift.
Yeah, Manley, I couldn't have said it better. Here's what I keep hearing from clients as well. Hey, Anthony, I'm just going to wait until rates come down. And I understand that logic. I really do. But what they do not understand is why rates were ever low to begin with. Rates were low because of a 50-year agreement. Oil was priced and traded in dollars. Hello, Petrodollar. Every single country on earth needed dollars to buy energy. That kept global demand for our currency artificially high, and it kept borrowing costs artificially low. It is why America could run massive deficits and still offer affordable mortgages for decades. That system is now breaking down in real time, and we're watching it. And nobody's talking about it at the dinner table because most don't even know what the heck a petrodollar is. But mortgage guys like us, we're watching it, and we're watching it collapse. And we are watching rates stay elevated because of it.
2 years ago, Saudi Arabia quietly ended their exclusive petrodollar agreement with the United States. I mean, quietly. No press conference, no breaking news alert, just done. Kind of out the back door. Here's what happened after. Russia is now selling oil to China in the yen. India is buying Iranian and Russian oil settled in the yen. And countries that used to need dollars to function on the global stage, they're building a parallel financial system. And here is exactly why that matters for you and your mortgage rate. When global demands for dollars drops, the value of the dollar weakens. And when the dollar weakens, inflation rises. And when inflation rises, the Federal Reserve cannot cut rates because cutting rates would let inflation run wild. Your mortgage rate, it's going to stay elevated, not temporarily, structurally. That is the shift nobody is talking about.
That's right. And when you add the Iran conflict on top of that, Oil above $110 a barrel right now? You've got to be kidding me. The 10-year Treasury yield, it's sitting at 4.6% because bond investors, they're pricing in persistent inflation. Not temporary, persistent. And here is what most people generally do not know or understand. Mortgage rates do not follow the Fed fund rate. They don't. Mortgage rates follow the 10-year Treasury yield, not the Fed. So even if the Fed cuts rates, even the 10-year stays elevated because guess what? The geopolitical pressure and the dollar weakness, your mortgage rate does not move meaningfully because of it. The mechanism that people are waiting on to trigger rate relief, it may never come. That's the real objection to wait and see strategy. The engine that used to bring rates down, it's running on a completely different fuel right now.
Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
So let's talk about what is actually happening here, because this goes much deeper than Iran and oil prices. We're watching a global changing of the guards in real time. The post-World War II financial order that America built and dominated for 80 years is fracturing. Look at the United Kingdom right now. Their two-party political system just collapsed in a historic local election. Nigel Farage's Reform Party triggered what analysts are calling a complete reshaping of British politics. Labour projected to lose over 300 seats. The establishment dismantled almost overnight. And this is not isolated. When America's closest allies' political and financial systems fractures, it signals that the old order is under genuine stress everywhere, simultaneously. And that's not a coincidence. That is the system breaking down.
That's right. And here's how all of this connects directly to you sitting in your living room wondering whether to buy a home right now or stay a forever renter. What we are describing, it has a name. It's called stagflation, your new best friend. Persistent inflation combined with stalled economic growth. It happened in the 1970s with your mom and dad when oil spiked and the dollar weakened simultaneously. Sound familiar? Based on everything we are looking at right now with elevated oil, weakening dollar, and geopolitical disruption that is not resolving, and a Federal Reserve caught between fighting inflation and supporting growth, the probability of entering a stagflationary environment within the next 5 years is now above 60%. You've heard that right. This is not a prediction. That is what the data is now pointing towards. And if you think this is doom and gloom, hear me out. Because what stagflation actually does is very different from what most people believe.
Stagflation does not crash housing prices like 2008. In 2008, people had adjustable rate mortgages, stated income loans, and negative equity. When rates reset, people could not pay. Foreclosures flooded the market. Prices crashed 40-50% in some areas. Stagflation does not work that way. Stagflation does not crash prices. It stagnates them. Nominal prices stay flat and grow slowly, maybe 2 or 3% annually instead of 5 to 7. But here is the crucial part. If inflation runs at 4% annually, in 5 years, a $500,000 home nominally costs $550,000. But in today's money, that's actually cheaper on a real basis. Meanwhile, the homeowner with a fixed rate mortgage at 6.2% is paying exactly the same payment forever.
Yeah, but renters, they get destroyed in stagflation, like completely destroyed. Rent adjusts every year with inflation. It's that simple. If inflation runs at 4%, a renter paying $2,500 a month today will be paying over $3,200 by year 5. A homeowner locked at 6.2, they pay $2,700 forever. That payment, it doesn't change. And that's the protection of a fixed rate or a homeowner. That is the shield against stagflation. That is why buying now at 6.2% is actually buying an insurance against what is coming, because Mark my words, it is coming.
Billy, you got a kid in there that's got a degree in economics from Yale. You got a scout here with 29 years of baseball experience. You're listening to the wrong one. Now, there are intangibles that only baseball people understand. You're discounting what scouts have done for 150 years, even yourself?
Adapt or die.
So here's what is actually happening at the macro level and what you need to do with that information. America is not sitting still while this plays out. There is a deliberate transition underway in global finance. Whether it ends in digital dollar or a restructured currency basket or some form of commodity-backed system, the end game is that the current petrodollar framework gets replaced with something new. That transition takes time, and during that transition, rates stay elevated and volatile. Not crashing, not spiking catastrophically, elevated, volatile, with a small window of relief that opens and closes fast. That is the terrain for the next 12 to 36 months, and you need to plan accordingly.
Yeah, so here's what you actually do with that information starting now. Stop waiting for rates to return to the 5s or 4s on a sustained basis. It's not going to happen. That is not the base case right now. The base case is mid to upper 6s with occasional dips. And here is the key. This rate environment is your comfort zone compared to where this is heading. You are not timing the market. You are not waiting for perfection. You are accepting reality and acting on it. On a $450,000 home at 6.2%, you are looking at a roughly $2,700 mortgage a month in principal and interest. That payment does not change for 30 years. If inflation runs at 4% annually in 5 years, that payment, it's worth about $2,200 in today's purchasing power. But guess what? You're locked in your cost. The renter, it's locked in nothing.
And here's the piece that people really need to internalize. This is not about timing the market. Nobody can time this market. Not economists, not the Federal Reserve, not us. This is about being in the market versus being outside of it. The people who bought in 1979 at 13% mortgage rates and held on came out substantially ahead when conditions normalized. The people who waited for perfect conditions missed the entire decade of equity building. History is rhyming right now. The storm, it's already here. And the only question is whether you're inside with a fixed rate shelter or you're outside watching it come through your window.
Yeah, and here's what you really need to do starting this week. If you are renting and you're thinking of buying, you need to have this conversation. I'm talking this week, not next month, this week. Get pre-approved so you know your exact position and what you can actually qualify for. Stop waiting for rates to dip and seeing a perfect scenario. Stop hoping for a better window. This is the window. Lock in your 6.2% rate or whatever rate you get right now. Build equity. Stop paying rent that climbs every year with inflation, because every month you wait is another month of equity that you're not building and another rent check that builds nothing for you.
And if you're already a homeowner with equity, understand something. That equity is a hedge in a stagflation environment. Real assets hold value. Your home is a real asset. And if you're sitting on the sidelines waiting for prices to drop 50% the way they did in 2008, hear this clearly. That is not what stagflation does. Prices do not crash. They grind sideways while inflation eats their real value. And every month that happens, you are on the outside looking in.
The market's in an itsy-bitsy little gully right now. It's like everybody said, okay, that was crazy, let's just all calm down. I sold that house for $350 the year it was built. 2 years later, $480. Then $585 maybe 18 months ago. This couple bought it for $650 last year. You'd let it go for that.
Let's ground everything we just talked about in real numbers. Here's exactly where we're sitting right now on May 18th, 2026.
Okay, Manley, so the 30-year fixed mortgage rate is sitting at 6.8%. That is where we are trading right now. The 10-year Treasury yield is sitting at 4.6%. bouncing from 4.6 to 4.65, depending on where the wind's blowing. This is the number the mortgage rates follow directly. Watch the 10-year. It tells you everything. And if it breaks above 4.75, mortgage rates, they're going to be higher. That is the number to track this week and everything going forward.
And that's your reality check. That is where the market stands right now.
It's just money, and it's certainly no different today than it's ever been. 1901, 07, 29, 1937, 1974, 1987. Jesus, didn't that me up good? 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves. And you and I can't control it or stop it or even slow it. Or even ever so slightly alter it. We just react.
Okay, here's what this all means. A global financial order that has been in place for over 80 years is fracturing in real time. The petrodollar is declining by design. Stagflation carries a greater than 60% probability based on what the data is actually showing us right now. And in that environment, a fixed rate mortgage, it's not a burden. It's the single best inflation hedge available to regular American families. The storm, it's already here. The only question is whether you're inside or outside when it fully arrives.
So if this episode made you think differently about waiting, send it to someone right now who is sitting on the sidelines. They need to hear this. Subscribe, leave us a review, and we'll see you next week on the Mortgage 101.
Girl from the heart of Wisconsin to the waves of Hawaii. Manley and Anthony keep it real, not salesy. Breaking down rates and the truth you need to know with a little soul and a little homegrown flow. It's the Mortgage 101 podcast where real talk meets home at last. Manley's got that Midwest soul. Anthony brings that island roll when the market swings and you don't go fast. Tune in, the Mortgage 101.